Hey everybody, welcome back to the channel for another valuation video this week, and it is our last of our valuation series. After this, we're moving on to a new set of videos. So I apologize for last week. There was a DCF video that was only half uploaded without the Excel tutorial, so we've re-uploaded that. Go check it out. It's about 21 minutes. It's definitely on the longer side, but it covers everything you need to know. And so we've covered now income-based valuation, which includes capitalization of earnings, and the DCF, which are definitely the two most common. And then we've looked at market-based valuation last week, which was based on market valuation. And this is probably the second most common. And now we're going to the least common, which is cost-based valuation. We look at how we can value a business using only its assets and what it would cost to replace all of those assets within the business. Definitely a bit more work and probably the least used, but you'll see exactly what this is about if you watch today's video. So again, this is the last video in this series. I hope you guys enjoy this one. It's a little bit on the shorter side, a little bit short and sweet for once. So I hope you enjoy it, and I'll see you all next time. Welcome back, all of you valuation specialists and investonomics fanatics. This week we are looking at cost-based valuation, the third of the types of valuations that we can use for businesses, assets, or projects. So this video is the last of our business valuation series. We're going to take a look at the last of the three methods, as we've mentioned, which is that of cost-based valuation. The others include income-based and market-based valuation, and definitely check out our channel if you haven't seen these already. Cost-based valuation is often viewed as a method of last resort for valuation, since when this is applied when other methods are not applicable or don't offer accurate valuation results. The basis for cost-based valuation is the cost in order to replace all of a business's assets, tangible and intangible, if they were taken away from the business. In general, it is a measure of last resort since it's more uncertain than other methods. This means that there's a lot more variance in the possible valuation figure derived from this kind of valuation, meaning it's typically presented as a range. Oftentimes, this means a valuation is utilized to offer an extension on the range of football field ranges for valuation. And if you haven't seen this yet, take a look at our DCF video for more information about that. If it is in fact used as a primary source of valuation, it's often when assets don't generate cash flows, there's no income in this case, to implement a DCF, and when there are no comparable businesses on the market, which means that market-based valuation does not suffice either. Essentially, it's used as a last resort if market-based and income-based valuation are rendered virtually useless. Cost-based valuation is paramount in order to value intangible assets, and there's essentially no other way to do it. This is because they don't generate cash flows, and they can only be valued based on what it would cost to replace it. So intangible assets are assets that aren't actually measurable in financial terms. So as an example, a company's website, which is an intangible asset, costs much less to replace now than it would have 20 years ago, and this is mainly due to technological innovations. Website creation has become much cheaper, and the cost to replace it is much less now than it cost 20 years ago. And this is pretty important in terms of analyzing the costs. Cost-based valuation relies on the current market prices to replace all assets of a business. Even if assets are not changed over time, cost-based valuation may offer different valuation results from year to year because of this, as market prices change. The cost to replace the asset is its current market price, and that's the main takeaway here. Now, the main problem with this approach is the amount of research that's required to do an accurate valuation. This is amplified when businesses have many assets as well as intangible assets, and the difficulty comes in finding the exact replacement cost for each asset, and may prove difficult and very time consuming. Another issue is that when there is no replacement that can be found, or not a close enough match for that asset, it may become very subjective in the eyes of the valuator, and may be inaccurate overall because of this. Overall, the company's enterprise value can be found with the following equation using cost-based valuation. So we have the reported assets of the business plus the unreported intangible assets minus less cash minus less company liabilities minus unreported liabilities. Using the cost of replacement of assets for a business to arrive at an accurate valuation figure is possibly the most difficult of the three methods, and alongside its uncertainty is the valuation of last resort, as many financial individuals choose it. So that now concludes our video series on valuation. This should provide an intuitive way to value virtually any asset, project, or company. So happy valuation, and I'll see you all next week.